Morning, ladies and gentlemen, and welcome to another hedge fund webinar by BCI and FundRock. My name is Pierre de Klerk, and I work for Apex Investment Consulting. Eugene Brock, who normally introduces the moderators, is unfortunately elsewhere engaged today, so I'm introducing myself before I introduce the panelists, but I work for Apex Investment Consulting, and I'll say a bit more about our business in a moment. To immediately introduce our speakers for today, we are joined by Adrian DeFay from AG Capital. We are also joined by Nomatibana Okello from Terebinth Capital, and by Patrice Moyal and Offrey Kalon from Visio Capital. And I hope I got the pronunciations of all the surnames and names correct. Just a few words maybe about Apex Investment Consulting. We are a sister company to BCI and to FundRock, and we are asset consultants. We have a long history of doing asset consulting work to financial advisors and other entities, and we've been around for a number of decades. Our team, we are a team of essentially 10 investment people, and in our previous lives we used to be responsible for the asset consulting to the retail channels of some of the large life insurance companies in the country, and about, well, now in excess of 10 years ago, myself, Robert, Tavonga Shavize, who is our Chief Investment Officer, started working together, and our company went through a few name iterations, and in 2023 we were acquired by the Apex Group together with BCI, and we then renamed to Apex Investment Consulting. But as I mentioned, we provide multi-manager and consulting services to IFAs. We have quite a number of IFA clients or IFA groups and firms as clients. So if you have any interest in what we do, what we can provide, or the research that we do, if you just want to have a look at the type of research we do, or if you even want to just have a once-off opinion about your multi-managed products, if you are a FSP that run multi-managed portfolios, we'll be happy to engage with you on that. I also thought I'll, as the previous time, give a bit of an introduction just broadly about the hedge fund space. We've had a few of these hedge fund sessions already, and I think what you would have kind of gathered from that so far is that we try and hit a balance between kind of education and product exposure. So we definitely kind of lean on the panelists to give insights into their philosophy and strategy, theirs, as well as general insights about the hedge fund industry, because we are very much in South Africa kind of in a period of upscaling consumers, or upskilling consumers, I should say, in terms of the hedge fund space. Now, I can't not say this. I thought of it earlier, and I said I can't not say this, but in South Africa we are a bit in a make hedge funds great again, or make hedge funds great moment over the last number of years, because our regulatory framework eventually changed to make hedge funds much more accessible to the retail investor. And now slowly we're making good inroads in getting hedge funds listed on the list platforms, the Link Investment Services Providers platforms, and we see it in the hedge fund flow. So certainly the hedge fund industry have been flourishing over the last number of years, and many of the hedge fund managers and products have delivered handsomely to investors. So I think it's quite an exciting space in South Africa currently. As you would have gathered from previous sessions as well, is that it's a very diverse environment in terms of the different strategies on offer, the different approaches that managers take, the different elements within their businesses that are focus areas, and today is no different. So in each session almost we had a good diversity. And today also we'll hear from Adrian about how quantitative and technology works together with discretionary or human capital. So that's one angle we'll investigate or hear about. We'll hear about fixed income hedge funds from Terebinth, and then Patrice and Visio Capital are very well known for their engagement strategies, and that's another unique angle to some managers and certainly to Visio, and we'll explore the degree to which that adds value to the process and to the product. For the last 4 or 5 minutes that I have time for as part of introduction, I thought I'll say something about hedge fund fees or fees in the hedge fund space. Now, it's kind of a contentious matter in a way, in that the fees are higher than what it typically is in the long-only space. And in these sessions, we haven't focused on that yet, and we kind of tried to steer away from it a bit so as to not kind of fall into long debates. But I do think one day I'll encourage FundRock and BCI that we should do a separate session on hedge fund fees and all the different aspects around it. And then maybe we can have a healthy and constructive debate with some hedge fund managers that offer insights. But I thought from my side, I'll maybe just mention a few things today, almost to tease your thoughts and to, things that you can think about until we get to such a session. And the few things I thought of saying is, when you think about hedge funds, and that we've heard before, they have different benchmarks based on what the approach is. So some hedge funds are much more directionally oriented maybe, or aggressive, and they might have a benchmark that is more market related, more related to the equity market. And then other hedge funds, in the classic definition of a hedge fund, will aim to protect capital and provide absolute returns in a very uncorrelated way to the market in many or most market conditions, and they might have some sort of an absolute benchmark. So firstly, I think when you think about the fairness and the structure of fees, then you must kind of focus on what the strategy is and what the appropriate benchmark for that is. The other two elements that I thought I'll mention is that, as I've already now said, most hedge funds or many hedge funds will have as a stated aim to protect downside to an extent and to deliver absolute returns. Now, if you think about the protection of downside along the lines of insurance, and I kind of frame it in a more actuarial way of looking at it, then one can argue that insurance has a cost. And none of us that have life insurance or short-term insurance for that matter write letters to our insurers every month when we haven't had a risk event or we haven't died and complain about the premium we paid. So if you take that same line of thinking and you transpose it to the hedge fund space, then it one can understand from the theoretical point of view that if a product or approach or strategy offers protection, then it comes with a cost, and in the insurance wording, you can think about that almost as a premium, but there is a cost involved, and that might translate into higher fees, but you get that other structural element from it that you don't get from a long-only product. The other point is, many, if not most or all hedge funds offer or use a degree of gearing, and at least some of the returns or a portion of the returns that hedge funds generate is related to this gearing. And what the gearing simply implies is that you get the benefit as an investor of more than the R1 that you put in. That gearing gives you maybe R1.20 or R1.50 worth of exposure, which then translates, if the manager gets it right, into an enhanced return. Now, again, gearing, if you frame it in a banking concept, gearing is really someone lending you money, extra money that you can expose to the investment or to the market. And just like our banks don't lend money to us for free, neither does the market in a sense. So if you use gearing or you get gearing as part of your hedge fund product, which is in a financial engineering way structured in a sense that the market lends you the money, if you can put it that way, through the derivative structuring, then it's also theoretical easy to understand that there must be a cost to that lending that you receive, or that borrowing, and that gearing. So those are the kind of structural elements around the fees of hedge funds that I think one can debate into the future and take into account and think about. So I just thought I'll mention that today as a few interesting elements. We're going to move on to the first speaker now, which is Adrian DeFay from AG Capital. And AG Capital is a business that does a number of things, but hedge funds is a big part of what they do. I'm sure Adrian will cover some of that, but we look forward to your presentation, Adrian. And sorry, the last thing to the audience, you're welcome to post questions in the Q&As. We'll keep an eye on that. We'll take a few questions after each speaker, and then if there's time, we'll take some questions at the end. Otherwise, we'll get back to you with answers. Thanks for joining us, Adrian, and over to you.
Thank you, Pierre. Just please give me a minute to set the slides up, if you don't mind.
No worries. We can see them. If you can maybe just put them in full slide view. Yes, 100%.
Is that okay?
That's 100%. Thank you.
Okay, please stop me if it doesn't appear slide 2 or 3 or whatever, and I'm talking away, Pierre. Thank you.
Will do.
Well, good morning, ladies and gentlemen. Thank you for the opportunity of allowing me to present. I think I've got a reasonably interesting topic for you today. It's really on how we do things, or rather how we intend doing things into the future at AG Capital. And that involves our investment process and the integration of quantitative research capabilities with discretionary research and discretionary fund management. I feel that the whole modern hedge fund landscape at the moment is rapidly evolving, and the realization of the need to increasingly use quantitative tools with discretionary insight has indeed become most important. The goal being to harness strengths of both and to enhance one's edge and hopefully reduce certain blind spots which naturally occur in one's investment process. Just to repeat a few obvious points is that the quantitative investment approach is entirely rules-based. It's a systematic approach, largely using models such as optimization models. It emphasizes data, statistics, machine learning, and automation. Its key strengths are its speed, objectivity, scalability, and the back testability. Discretionary investment, it's a human-led decision-making process based on judgment, experience, and context. It's often a narrative-driven and macro-informed process. The key strengths are its adaptability, its particular nuance, and context sensitivity. The advantages of quant strategies, are its discipline. It reduces behavioral bias in human psychology of the normal emotional decision-making. The breadth of which it can cover, we all know it can scan thousands of stocks and data simultaneously. The consistency of it is that it executes according to predefined logic, regardless of any emotion. The advantages of discretionary strategies, on the other hand, are the pattern recognition and judgment in non-linear environments. It's effective in navigating regime changes in countries and jurisdictions, and of course, macro inflection points. Its ability to evaluate soft factors such as assessment of management credibility and any geopolitical nuances. What we try and do is to integrate both the quantitative and discretionary techniques because we believe that is the way that we can really maximize our process for our investors. To illustrate what I'm trying to say here is that the quant side may, for example, start with a certain source idea. It will then be looked at from a discretionary aspect and whether to validate it or override it. Inversely, a discretionary thesis may be developed, and thereafter we would test it, quantitatively speaking. This naturally is a constant feedback going from discretionary to quant, from quant to discretionary, and this, we believe, enhances our process. Practical examples are using a quant system to identify certain valuation dispersions and then handing it over to the human portfolio managers. Excuse me, I just need a bit of water. To filter through those various catalysts. Inversely, the discretionary trade thesis might be that interest rates are going to rapidly increase or decrease. And then one could run a simple model of what would be the most sensitive stocks on certain bases. Using non-linear programming to extract sentiment and then overlay discretionary judgment would be the way that we would seek to best do this. Risk management implications of the quantitative system are that the systematic overlays can mitigate certain discretionary drifts in portfolio management. The discretionary input, on the other hand, can also flag false positives in quant signals. The combined approach enhances robustness under market stress in particular. Building an integrated team is what we try and do and what we are trying to do increasingly, and it's a cross-functional collaboration between the portfolio managers, fundamental analysts, and our mathematicians on the quantitative side. The shared language tools and feedback mechanisms are constantly being implemented. And finally, there's a balanced culture and mutual respect for both sides of discretionary and quantitative. Our conclusion is that integration is certainly not a compromise. It's a valuable synergy, and the future of hedge fund management, in our view, lies in combining human insight with this computational power. Managers, we believe, who can master both disciplines will be structurally advantaged in the future. I'd like to take you through a practical example of what some of our recent work has shown and revealed. And we certainly found it quite interesting. We labeled it the Amiga model, and it's a model which will enhance decision-making for our discretionary fund managers. We believe it will also be able to survive on its own as a pure quantitative-driven system. It will provide quantitative validation for trade ideas by identifying asymmetric risk-reward opportunities. It improves discipline by highlighting when probability-adjusted returns align with the discretionary thesis. This project starts with market beta, and you may ask, why high beta? The high beta stocks tend to lead in periods or outperform in periods of economic recovery and market expansion. And certainly in our work, we find that the significant market inefficiencies probably caused by people mispricing high beta stocks largely, and thereby creating what we see as the alpha opportunity. We found that when filtered correctly, the high beta portfolios can outperform on a risk-adjusted basis, and that in our instance of the South African equity market, it is particularly suited to a high beta approach. Looking at the last 8 to 9 years, this is a graph that will show you the high beta portfolio in the blue line versus a low beta portfolio in the blue line, a high beta in the red, and then the index is in the middle. The index here is the top 40. The black line in the middle, being the JSE top 40, naturally has a beta of 1. And typically, portfolio managers tend to look for, particularly in our market, tend to look for low risk opportunities. They look for consistent growth. And largely what's being used is the capital asset pricing model. That is then often reflected in lower beta stocks as a result in the portfolio. And as you can see by empirical data, that strategy significantly underperforms or causes a drag, or in this history had caused a drag. The process which we followed was using the top 40 index of equities in the South African market. We developed an optimization framework which was selecting high beta stocks based upon annual positive returns. The major enhancement of this was a semi-annual rebalancing, and it was that step which significantly enhanced the returns. The continuous exposure monitoring relates to risk parameters within a certain portfolio, such as percentage exposure to single stocks. The graph below here shows the results of this model over 10 years, which returns a rather spectacular 724%. Versus the JSE top 40 of 176%. And this is literally 4 times the difference. It yields an annualized return of 23% per annum versus 10% for the JSE, and an active return or positive alpha of 12% per annum. The Sharpe ratio also comes out very favorably at over 1. So we believe the model is not only for internal development for enhancing our discretionary fund managers, but it's also viable enough to develop into a standalone fund, which we hope to be launching over the next few months. This fund will function entirely on the quantitative process and will be machine driven with the signals which we've coded in using the Omega framework. It will remove all behavioral bias naturally, and it delivers a repeatable, disciplined performance, in our view, from a purely quantitative approach. Whilst the fund is fully systematic, the Omega model also serves as an aid to discretionary fund managers and providing, hopefully, insights that can support their judgment. Yeah, that's really the end of my presentation, and it was just an illustration of using the some quantitative modeling to enhance the normal fundamental discretionary process. So, Pierre, if you'd like to ask any questions.
Thanks. Yeah, thank you, Adrian, for that kind of overview and teaser about quant and combining it. I think there's a lot more to interrogate about that. I've thought of some interesting questions about the Omega process that you touched on at the end, and certainly that'll require a lot more kind of explanation and interrogation by users to fully understand it. But the one thing I thought of was that there are not that many high beta products certainly available in the SA space, as a unique style. And the question I thought of was, if this was going to be implemented as a hedge fund or in a hedge fund structure, and because beta is kind of it works on the upside and on the downside, does this then imply that high beta would be of some kind of amplification benefit to the downside where shorting is involved, or does it get too dangerous when you go for high beta on the on capturing downside benefit from downside, put it that way?
Pierre, it's a very good question. The work that we've done with work that we have done so far entailed 20 years of back testing, which obviously, as you say, you need to integrate the whole process. And ostensibly what it was the optimization was, as I said, was to rebalance the portfolio twice a year. And during that 20 years, I mean, if you look at I hope this answers your question, the period of 2014 to say 2019, the market was flat to down during that 5-year period. And this strategy being long only in this instance, or the model really dealing with long only, outperformed in that period as well, outperformed the index. We, as a result of that and the entire period, we didn't find the necessity to start getting too clever at this stage and using it as a shorting tool as well. That may naturally evolve, but this is what we had come up with. So it was really meant as a tool. How we started, Pierre, was to enhance our hedge fund managers who tend to congregate around certain stocks. So if you look in South African hedge funds, they're very congregated in certain trades for largely fundamental reasons. So when we were developing this model, it was an enhancement to say to them, look, girls and boys, you shouldn't be in these stocks. You should consider some of these as well. And this could and probably will enhance your performance. So it was really just a stock selection basis. And then we saw, well, actually, if you ran it long only and you just did this reweighting or rebalancing twice a year, these were the results. And obviously, we haven't imputed costs into those. But the portfolio would only turn twice a year. There'd be dealing costs, there's management fees, and whatever performance fee you put in there. But it would still outperform significantly. So the answer is, Pierre, we haven't adapted yet into running a long short out of it.
Thanks. And just picking up on the comment you made about the fundamental positions in South Africa, I think it is fair to say that, over the course of the development of the hedge fund industry in South Africa, and also in recent years, most managers are of a fundamental nature, maybe with technology or quant assistance, but we don't have many pure quant hedge fund products in South Africa. There might be a few, but not that many. I know you have extensive international experience, work experience as well. So the question is, can you give us a sense what is the direction of development internationally as far as hedge funds is concerned? What are the new trends? Is what you've talked about today part of part of the international trend?
Sure.
Because we always, obviously, as South Africans, wonder: are we on par? Are we behind? Are we ahead?
Pierre, well, internationally, I think some of the trends are, I think it's over time, it's very difficult to find. Our first observation is, and our knowledge is, it's very difficult for managers to outperform the American market, using the benchmark of, say, the S&P 500. So to be able to, what that is, that for a manager to come with a sustainable process system and to be able to do it constantly. As I think most of our audience know, Warren Buffett had that famous bet with a couple of the hedge fund managers on this point, and he seems to be winning the bet fairly consistently. That's the first thing. So that trend is becoming more so. So very, very difficult to create alpha out of the US market. Then secondly, Not because we do it, but we really believe in the process, as my presentation is about, of moving to more quantitative process. I think, the market had a tremendous fright, obviously, with the blow up of long-term capital management, early 2000s, 2001, and the fact that there were 4 Nobel Prize winners there, of physicists and mathematicians and everything, that really put the kibosh on quantitative for a long while. But if you look in the last sort of 4 years, it's very much moving that way. So in our opinion, we think that the South African market is a little bit behind in that trend. And then the other trend of international would be, I suppose it's a result of the difficulty of finding alpha. There's a consistent move, and I'm sure you see it as well from your managers, that have offshore portfolios. There's an increased movement towards looking at credit funds, all sorts of different varieties and hybrids and that. So I think those are just, I can go on, but I would sort of leave you with those 3 main points. So, difficulty of alpha, increasing move towards quantitative, and thirdly, the move towards credit side.
Private markets. Thank you very much for those insights.
No,
thank you,
pleasure.
Adrian. Please stay on the line and around. We'll get, I think, to some more questions at the end if we have time. But we'll move on to Terebinth now. Thank you.
Sure.
Over to you, Nomatibana. Welcome. Thanks for joining us. And Nomatibana will be talking about the case for hedge funds a bit, and also about their process and their product, which is a fixed income hedge fund. So something quite different. Thank you.
Thank you to the FundRock team for the invitation. So I'm going to be talking through our hedge fund product, which is a fixed income macro hedge fund, just covering some of the basics around the investment philosophy and process. And in summary, the investment philosophy and process is twofold. We're looking at the macroeconomic environment, and we combine that with quantitative precision, because the fixed income asset class is quantitative in nature. So looking in terms of the actual experience, in terms of how our hedge fund product has performed, we've been a recipient of a number of awards within Hedge News Africa, APSIP, and most recently the Edify Group. And we've also been nominated a number of times. And the key thing to highlight is that we've not only been nominated or won within the fixed income category only, but also within the broader hedge fund community, which shows that a fixed income hedge fund is capable to outperform, not just within fixed income, but within the broader hedge fund community. So to start off, I thought maybe let me just cover what should a typical hedge fund do for you. From an absolute return perspective, a hedge fund should not be benchmark cognizant. The aim is to give you a profit from both a rising and a falling market. You should get diversification benefits with a hedge fund, in the sense that there's low correlation in a hedge fund to traditional asset classes. And therefore, it means that if you combine it within an overall portfolio, you should have lower volatility in that portfolio. The key component of any hedge fund manager is risk management. So therefore, having a strict risk management framework in place, and in our universe, or in our world, also involves having strict downside protection and stop losses in place. And that is important to ensure that you protect against those extreme market downturns. And in terms of the tools kit relative to a long-only portfolio, you'll find that hedge funds will have a wider toolkit relative to what you see in the long-only space. And that's what allows us to benefit in both rising and falling markets. And lastly, hedge funds, in line with the opening comments, they operate in a well-regulated environment, so which makes it accessible to investors in line with what you'll see with a traditional unit trust. So I'm hoping with this slide pack to cover some of those items. just to illustrate the benefits using our fund as an example. So in terms of a risk management framework, what's important for us is ensuring that we address key person risk. This hedge fund has 3 senior PMs that operate. We have our CIO, Eric Nall, as the lead PM. We have myself as a co-PM, and Johan Kutz as also a co-PM. So it ensures that this key person risk is addressed. From an operational risk perspective, we utilize multiple prime brokers, and therefore we diversify balance sheet risk. Balance side risk is a key and a big risk when it comes to fixed income hedge funds. So you must be able to diversify that risk. We utilize independent administrators that provide independent valuation on the portfolios. And also from a risk perspective, we do calculate risk measures internally, but that's externally verified by different service providers. And then from a liquidity and credit risk perspective, as a macro house, we implement strategies in deep and liquid markets. So therefore, that is important for us to address liquidity risk. And from a market risk perspective, pre-trade compliance is important. As I mentioned, we have mandated stop losses. So in terms of how those practically work, if the fund is down 2%, we will remove 50% of the overall risk. And if we're down 3%, we'll essentially remove all risk in the portfolio. So that ensures that we are able to cap those downside, especially in those extreme market periods. So the Terebinth FI Macro Hedge Fund, this is a product which has an objective to provide returns in excess of 5% over the benchmark on an average annual basis over a rolling 36-month period. And we want to do that with a low degree of volatility. In terms of the universe or how we actually conduct that, it is through qualitative, and that is primarily macro research and analysis, and quantitative methodologies. So the quantitative methodologies, as I mentioned, fixed income is a quantitative asset class, so therefore you need to have quantitative models to understand what is in the price. We typically split those strategies into strategic trading opportunities, into structural trading opportunities, and tactical trading opportunities, which I'll cover. So what you typically get with a fixed income hedge fund, just looking at a typical curve, and in this instance, I'm not specific in terms of what type of curve that is. You'll tend to see strategies being implemented in the short term, in the middle part of the curve, and in the long term of the curve. The short part of the curve is very sensitive to monetary policy. The belly part of the curve is sensitive to the macro cycle, and the long term is sensitive to fiscal policy. In terms of how we manage this portfolio, we manage it across these strategies. There's no specific area of the curve that we focus on. It really is a function of the macroeconomic environment and where trading opportunities lie. And then in terms of the trades that we implement, they are strategic in nature, so those will tend to be macro-driven. They have a medium-term horizon. Structural trading opportunities, typically sensitive to supply-demand dynamics in the market, and the supply-demand dynamics will have an impact on market dislocations, or will cause market dislocations, and that can provide trading opportunities. And then lastly, you have tactical trading opportunities, very much data or event-driven, short-term horizon in nature. But as a macro house, the bulk of our strategies will be concentrated on strategic opportunities. So as an example, a strategic trading opportunity using monetary policy. So what I've illustrated here is I've taken the FRA curve, which is essentially gives us a forecast of what the market is expecting future JIBAR to be. And I've essentially with these bars comparing it to JIBAR, current JIBAR. So therefore, forecasting what the expected interest rate cuts in this instance would be over a 2-year period. And then we look at multiple scenarios in order to assess trading opportunities. So the first scenario is in line with what's happening with the SARB and wanting to anchor inflation around the 3% level. So the first scenario is if inflation stays low at 3%. in which case the SARB will have conviction to actually continue to cut interest rates more aggressively, and it will be a bullish outcome for short-term interest rates. As a trading opportunity within this, within a hedge fund, we can essentially receive the rates in the floating rate, or sorry, in the forward rate agreements, because then relative to what is currently priced, which is just one cut, in an environment when inflation stays low at 3%, the SARB will have conviction to cut further. The other opportunity is with scenario 2 is where we see global recession, which spills over to South Africa, because growth concern is still a function currently in the market. In which case, in order to encourage growth in the economy, the SARB will likely continue to cut interest rates. And this can also be a bullish outcome as a trading opportunity we could receive, because the FRA curve will move lower. Another scenario is where inflation actually rebounds to 4.5 and above, in which case, given that the market is currently pricing a cut, this would mean that it's likely that it will not cut from here going forward, and it's an opportunity to actually pay the FRA curve. So this is an example. Obviously, assessing at the macroeconomic environment and monetary policy can be an opportunity for a strategic trading opportunity. The other example is a structural opportunity. In this case, if this is this curve currently, which is in blue, a scenario is where debt stabilizes in line with budget projections, in which case it will be a bullish outcome for rates, and therefore we're likely going to see the rate curve moving lower and flatten. So in that scenario, you want to receive. And the reason this is structural is because with a bullish debt projection, it means that the issuance profile will likely go down, and therefore supply-demand will be changed in the market. Second outcome is when debt stabilizes at current levels. It is a bullish outcome, but not as bullish as scenario 1, in which case the curve will actually just flatten. Here you want to receive at the back end of the curve. And another scenario is where debt does not stabilize, in which case we have a bearish outcome and the curve is likely going to move higher. In this scenario, you want to be paid the curve. And then just lastly, as a tactical example, what we do is we fit the curve in terms of where the dots currently are, or the rates currently are trading in the market, and we assess rates that are sitting above and below the curve. A rate that's sitting above the curve is cheap, is simplistically considered cheap, and one below is simplistically considered expensive. So this could be an opportunity to receive the bond that's sitting above the curve, and you want to assess it relative to its history, how it has been sitting above the curve. You want to receive that curve, that point, and pay the point that's sitting below the curve. And this is simplistically a relative value trading opportunity. So what that does over time, if you are able to implement these strategies, this is a return profile that you want to receive with a hedge fund. You want a hedge fund that, when you're looking at in terms of the beta relative to the market, it's able to capture the upside in most months relative to typical indices in the market. So in this instance, we're comparing it to the ALSI index and the ALBI index. So therefore, of the 74 months since the inception of this product, that the ALSI index has been up, the fund has been up 66 of those months, and of the 81 months that the ALBI index has been up, this fund has been up 78. The secret sauce is on the downside protection. Of the 54 months that the ALSI has been down, this fund has only been down 15. And of the 45 months that the ALBI index has been down, this fund has been down 17 of those. So if you are consistently able to do that, you generate a return profile that, from an annualized return perspective and a standard deviation perspective, it is superior. So our strategy is sitting at a return significantly higher relative to the ALBI index and the ALBI index, but from a risk perspective, it is a fraction, or otherwise doesn't deviate too much from what you're seeing in the ALBI index, and obviously a fraction of what you're seeing in the ALSI index. And then from an NAV, just looking at the chart over time, this is the return profile that you're going to see. Here we're just comparing it to the ALSI index and the ALBI index. And then another benefit is, I mentioned around correlation, how this product sits relative to other traditional asset classes. You see, when you're looking at the correlation of the product relative to some of the long-only indices in the market, it's really at a low correlation, which means that when you blend it within an overall portfolio, it reduces the overall volatility in the portfolio. So therefore, I think I've covered most of the bases when it comes to the benefits of the hedge fund by demonstrating with our strategy, we are able to produce an absolute return. We have a low correlation to traditional asset classes. Risk management framework is in place in terms of this portfolio. We are able to protect, or otherwise we're able to protect on the downside, obviously, and that's the absolute return. But then from a tool set perspective, our tool set is wider relative to what you see in the long-only space. And then just in terms of availability, this product is available in most platforms. And that's it for me. Thank you.
Thank you very much. That was very interesting. I do have some questions. The first question is, with reference to the impressively low correlations that one of the slides show for your product. If one takes that into account together with all the other benefits of the approach that you spoke of, then it appears that your strategy or your product, but maybe in general, fixed income hedge funds are close to the optimal investments. They offer broad toolkits, very uncorrelated returns, and so forth. But I think if one asks the average retail hedge fund investor, at least, they will tell you that they find fixed income hedge funds maybe a bit more difficult to understand or opaque or complex compared to long-short equity, because long-short equity, in a sense, is a bit easy. One understands long investing and shorting equity is essentially the opposite of that. So my question is, there's a few questions coming off what I've just said now. And the first question is, given these low correlations that you've illustrated for your strategy, just to get a handle on it a bit further, are there any market conditions that are particularly positive for your strategy or might be less than optimal? Or is it truly a case of you can, in all conditions, maintain alpha delivery and low correlations?
Sure. So we are a macro hedge fund. So therefore, there will be markets where, from a policy perspective, whether it's monetary policy or fiscal policy, there's interventionist policies that are being implemented in the market, which means that in terms of how the markets behave, they deviate to what we'll typically expect within a macro framework or understanding, just thinking in terms of the relationships from a macro perspective. And I've also mentioned that in terms of the bulk of the strategies that we implement in this portfolio, they are strategic in nature, and those strategic opportunities will be driven by the macroeconomic environment. The quantitative framework comes into place in order to assess what's is in the price. So therefore, when you have those environments, it's a very tactical environment. And it becomes very difficult then for these type of strategies to really outperform the STEFI index. What we'll do at minimum is give you there will be a cash-like return, but it becomes very difficult to really outperform because of the fact that the bulk of our strategies would be macro-driven in nature. But in periods where we have macroeconomic environment operating with less interventionist policies, and the policy framework is aligned to what we're expecting, this is a portfolio that should outperform nicely.
Thank you. There's one viewer or listener question, which is really essentially about your views on fixed income. And it says, how likely do you think it is that the SA government does get debt levels under control, considering their past track record? So unfortunately, you only have 1 minute to answer it.
I mean, how likely it is if you look at the history. it's very difficult to put a very high probability on them being able to implement it, because the thing is, everyone is going to look at the historical track record in sticking to a consolidation path within any communicated medium-term expenditure framework. It's been very difficult for them. But now we obviously we have to look at it in terms of the political environment that we currently have. It is a different government in the sense that we have government of national unity, and the political players in place will obviously try to move things in a different direction. We can already see there's small benefits that we're starting to see in terms of Operation Vulindlela. So we do see prospect for the government to be able to consolidate debt, not necessarily in line with the more attractive projections, but there will be some benefits that we're expecting to see. So it's really a function of the change in the political environment that will filter through to how expenditure happens within government currently. So I tried to just, but there's obviously, if you go through
obviously there's more detail.
Yeah.
Thank you very much for that. There is some more questions, but I think we'll keep them for the end. So please keep to the, keep on the line. We're just going to move on to the next speaker to give them their chance, and then we'll take some more questions or discuss some more questions with you. Thank you. Thank you very much for your presentation. We move on to Visio Capital with Patrice and Offrey. We can see your slides. Yes. And they're moving, but we don't hear you.
There we go. And you can see
Hi,
me.
Patrice. Yes.
Okay, and you can see me.
And we see you.
Good.
Yeah.
Okay, brilliant. Okay. Sorry, it's clicked on this one first, but here we go. Okay, well, firstly, thank you very much, Pierre, and the whole FundRock team. Olga, thank you for the 27 emails we got to remind us for this morning. So thank you, all of you, and welcome, and thank you to your audience for paying attention to some of the things we have to say. So first and foremost, just Visio. I'm not going to go into too much detail. We've been around since 2003. And to Pierre's points earlier on, what differentiates us, really, one of the differentiators has been we've always engaged very closely with companies. We run long, short funds, equity funds. You go short some things you don't like. You go long things that you like. In other words, you buy the things that you like. You sell forward the things that you don't like. And ideally, one will offset the other, and you can make a better return. And you haven't used much capital, because whatever you sold gives you cash that you can buy with, simplistically. This is the retail track. So it's 19 years old. It's not as old as our longest fund, which is since 2003. But you can see very briefly in the blue that we've outperformed over many years. I think more importantly would be the following. Where is it? We've got one which shows, how we've. Let me go to it. So it's moving a bit slowly. There we go. This one. I think this one's more important. This just gives you a sense of what a hedge fund's supposed to do, in that we're not going to outperform when the markets are rocketing. On the other hand, when there's trouble, we are expected to outperform. And that's what a hedge fund is hedge. Hedge is mitigating risk. That's what it's about. And you can see that in bear months, in months that have been down, we've actually shown a positive return. Now, it could have been zero, we would have been just as happy. But the fact is we protected the downside. And the most important thing in generating good returns over the long term is compounding positive returns. They don't have to be high, but it's compounding positive returns, not having to make up losses all the time. So in basically the bottom line is a hedge fund, or certainly the way we've done it, has been working, and that is to mitigate the downside. You may not make as much money when markets are flying, but again, when they're dropping, we're not there. So that's very important. Going back to what I'm going to talk about, and then Offrey, my colleague, will take the next 10 minutes, is this very topic. Hedge fund activism. Now, I got my job at LeBem in 1997, partly on the back of a letter that I'd written when I was working as a financial manager in a bank. I'm a CA. And that letter was when I was still working as a professional accountant and I was investing in markets and I didn't like something a company was doing. I had a 3,000 Rand investment in something and I wrote a letter. And when I went eventually for a job at Liberty, I took that letter was part of my application. And I liked the fact that I was engaging even when I wasn't an activist, I wasn't a professional fund manager. So to this day, we haven't changed that mantra. These are just, I mean, this only goes back to 2017, but we've got a very long list of companies we've engaged with over the years. We're not scared to tell our investors. We don't make it public. We've been above radar in the newspapers from time to time when we've had to do so, but otherwise we prefer to engage constructively with boards. There are some very recent ones. The more recent one, in fact, as of a month ago, was a very detailed letter we sent to Old Mutual, or 3 weeks ago. And, engaging with Mr. Trevor Manuel, he's the chairman, he's been there for 10 years or 9 years. It's not an easy task. You have to be cognizant of a number of things. Nonetheless, we wrote a very comprehensive letter. We got a response 2 days ago, but we're looking forward to many more engagements. And obviously, the important thing is it gives us, here's a copy of some, well, we're not going to go into each in detail, but this is just an example of what we've done. But essentially, we want to gauge the willingness of a board, of an executive team to actually make changes. Old Mutual, as I'll show you, in this graph here, or these graphs here, has been a shocker. A proper, disgusting shocker of a performance. And it's partly because of apathetic shareholders who really haven't given a shit for the last however many years. Because if there were activist shareholders, a lot of changes would have taken place a lot sooner. The bottom line is it's completely underperformed. It's a 58 billion Rand market cap. Sanlam is 3 times that at 190 billion. Discovery is 140, but even Outsurance is now bigger. I'm pretty sure most of your audience, we actually didn't even realize at the time that Outsurance is actually more than double Old Mutual. And Momentum, which we've been invested in for 3 years, has been a phenomenal return for us. That itself is just 12 billion short of Mutual. It's not impossible. Momentum could take out Mutual one day. The way Momentum is growing and what it's got, and what it's got still coming. And you can see on the right, the shareholder returns have just been disgraceful from an Old Mutual point of view. So it's an opportunity. It's an opportunity to engage. There'll be a change of chairman next year. And our letter consisted of a number of things that we unpacked. We're cognizant of the strength of Mutual brand, but it's really been a very, very poor performer, notwithstanding the fact it has some very strong businesses in it. And a business that's generating over 5 billion Rand of cash a year. It's on a P of 7. It's at a massive discount to its embedded value per share of nearly 20 Rand. It's trading at 12.60 Rand. We bought lower than that recently. And then we've not just bought in our hedge funds, and that's something you can't do in the long only. You can't do that in the equity fund. We've also bought options, 12 months options. So in other words, we get about 4-5% of the funds in Old Mutual, but we've also got options, which I won't disclose. Well, in fact, it's there. Oh, no, it's not there. But we've got options that if the share price exceeds a certain level, we make returns on that. And those options are pretty much going to cost us 1.5% in performance if nothing happens. The premium for the entire fund over the term of 12 months, and we will do rolling options, call options, is 1.5%. That's the cost. But the benefit, if Mutual actually does things right, is it could double in 3 years. And obviously the performance for the funds, and you can't buy options in a unit trust, in a conventional unit trust. So that is the benefit of a hedge fund. Now, for us, the engagement is important, only because it will give us an idea. So I just want to check the time. Give us an idea as to whether there is actually this willingness, this desire. We break down the factors that we consider to be important, and then they must answer to these factors. They must give us detailed responses to each point, because we ask questions. We don't simply make observations. Same could be said for Combined Motor Holdings, by the way. It's almost half its market cap in cash, 900 million. The market cap's 2.2. The CEO now, chairman or CEO, is Jeff McIntosh, he's been in the business for 30 years. He's the nearly 80, phenomenal, certainly a phenomenal executive, but there's a lot of value locked up in combined motor holdings too. So it's the fourth biggest dealership group in the country, roughly. So there's just tremendous value out there, and we want to engage on a friendly basis. We're not going to go out in the press and make a big noise. This is not an advertising campaign. We're doing this for the benefit of our funds. So these are some other special examples that we have, special opportunities in the portfolio. Forbes has been a phenomenal return for us. We've engaged with them in the past. We still do. Renette, we've tried, but it's very difficult with Johan van Zyl and Wilhelm van Zyl, or Johan Rupert and Wilhelm to tell them anything. I mean, we shouldn't tell them anything. Yeah, and in Supergroup, they're doing the right things. They've returned half their market cap in cash. The balance is very cheap. We really don't have to engage except on a constructive basis, give them advice, support them in any buybacks they're going to do. It's a P of less than 5. It's going to generate 20% of its market cap in cash. It is at the moment. And then obviously Old Mutual, which we've stated over here. So these are some of the ideas that are embedded in our hedge funds, and to the extent that we can, we put those in the long onlys also, where our preferences will be reflected in the long only funds. So this is a brief overview, given the time constraint. One other comment I want to make: Momentum has done tremendously well, just fixing themselves from within. Notwithstanding a flat market in South Africa, they've done phenomenally well. The share price has more than doubled. They've bought back 8% of their shares. And they're continuing to do buybacks because it's still at a discount to its embedded value. And we really honestly believe that in a few years' time, the India investment will be bigger than the whole of Momentum. So we are strong supporters of what Momentum and its management team have done. We'd love to see the same things over time with Mutual, and obviously the new CEO, which is important, the new CEO at Old Mutual, Yuri Stradel, who's been on the job 2 months now. That's the story from me. I'm going to pass on to Ofri. Ofri, should I unshare, or are you happy for me to still share?
You can share. That's fine. That's fine.
Okay.
Yeah, so we're just going to go quickly through probably one of the themes that we look at. The theme is power and air cons, air conditioning. I mean, they're actually like two kind of different themes, but they're actually very interdependent. One of the trends that we're seeing is AI. We think we are very, very early on in the AI adventure. And at the moment, a lot of the AI that everybody is using is very much text-based. In future, that's going to change. You're going to get AI in a visual context. It's going to be in robotics, it's going to be in autonomous driving, and that's going to be a lot more intensive in terms of compute. From the chart here, you can see that the US, Europe, and Japan over the last 25 years has really not added any significant capacity for power generation. With AI, especially in the US, that's probably going to change. The other trend that we're seeing is climate change. The weather is changing quite a lot. Areas are becoming significantly hotter. Air conditioning penetration in Europe is only sitting at about 20%. That is also going to change over time, and that is also related to power. These grids are very old, so even if you do put the generation on, you need to invest in generation, you need to invest in the grids. And we are playing this thing through GE Vernova, which does the gas turbines, and through AES, which does a lot of renewables. The gas turbines is the longer term capacity that they're bringing on. It's baseload power. Renewables is pretty good in the interim. It's fast to come on. And as batteries become cheaper, the batteries help you with the intermittent issues that you have with renewables. On the air conditioning side, as you're building out all these data centers, the more power that they consume, a lot of that power actually gets dissipated in the form of heat. To stop these very expensive chips from melting, you need to cool them down, and that's where Carrier, Lennox, and Trane come in. They are super specialists in these type of fields. Also in Europe and around the world, wherever you're having the climate change and air conditioning, we see that as a trend that we're going to have for a long time to come. How are we doing for time? Do we have time to go through the other theme, or?
Yes, absolutely. You've got 5 minutes, so you can
5 minutes. Okay, cool.
go through.
Okay, so the next theme is about aeroplanes. Running an airline carrier is notoriously, historically been unprofitable, has been a very volatile industry, but there's only 2 manufacturers of aeroplanes. It's Boeing and Airbus. You have the duopoly. Here you can see Airbus's market cap's $162 billion. The order book that they currently have is $730 billion. That's 8,700 planes. For Boeing, let's start with the one. With Boeing, the market cap's 170. The backlog is over 600 billion. It's 5,900 planes. On a good month, they deliver 50 planes. That means that you're getting about 10 years of visibility onto their financials, into the deliveries for the next 10 years, if they don't even add a single plane onto their order book from here. And then with the geopolitical tensions, security, defense, that could be something that just kind of like enhances returns. And for every plane that they sell, you get the servicing, the parts and the services. It's actually not too different to selling a car. After you sold the car, a lot of your margin actually sits in the maintenance of those planes. So in this sector, again, you can see you have visibility for at least like 10 years. And quite an interesting stat is 80% of people on Earth have never been on an airplane, which kind of talks to as GDP rises, as you know, we're seeing massive growth in India. We're going to see massive growth in Africa. As those people move up the wealth curve, they will utilize these airplanes in time. So just a chart on Boeing. I mean, it's been very volatile. It has had its own issues, but it is coming right. There's a new CEO there. Things are starting to improve. The green circles just shows like our entry point into it when things looked pretty bleak, and it's been a pretty good performer. And that's it.
Thanks, Wilfried. Pierre, that's it. We could carry on for hours. We got plenty more ideas. We just thought we'll hone in on some local and some
Thank you very
offshore
much.
as you guys wanted.
Thank you very much. Sorry, I had a bit of signal instability on my side, or seemed to be on my side, so I hope I'm back and you can hear me. Thank you very much for those interesting insights. And Patrice, I must say, you know, we're all suckers for juicy stories, I suppose. So last night when I went through the slide pack, instead of properly preparing, I read the front pages of those letters to the companies, you know, the bit that I could see on the slides. And I take it that you say you are constructive, and that's your approach. But I must say you're quite frank. You know, that letter to Old Mutual, going by the front page is it's fairly straightforward, quoting
Yeah,
your
we didn't
market
hold back.
research and so forth.
We didn't
So,
hold back, and we
so,
shouldn't.
So I think my the juicy question I suppose I want to ask based on that is, is your style truly this, to be constructive as far as you can, or is there a place for more acrimonious and more aggressive kind of campaigning in South Africa? Is it we all kind of read the Bill Ackman Herbalife stories from time to time, and we understand things are maybe done differently in the US, but how far would you push it? How, in your past experience, how close have you come to taking positions that speak as opposed to just letters, kind of maybe putting it that way?
Yeah, it's a good question. Look, for us, it's firstly important. It gives us more information, more comfort, more conviction. The more we delve, the more we engage. And you have to do it in writing. No point in talking because people get away with and say anything. But in writing, the board has to commit to a bunch of things. So in the responses we get, we can then gauge whether we are heading in the right direction or not. Because once they put things in writing, they are committing to certain things. And then you can put timelines or ask for timelines, and then you pursue it and you pursue it, and then eventually either they're doing the right things or they're not, and then you can say, well, this is investments it's just dead money. It's a value trap. There've been instances where we gave up, and in the end they did the right things. So most of the time the boards will do the right things. It makes sense, but we want to gauge it for ourselves, not wait for everybody else to hear about it also. And that's really, for us, the only way of doing it. So it's not a guaranteed success, but it allows us to position, if you're going to make money, you want the position to be of a decent size. If you're not sure, you put 1% or 2% in a fund and it gets you nowhere. But if you're more comfortable, you can go 4, 5, 6%, plus you can buy options. And so that's the difference between getting close without being given any inside information, but just getting closer by engaging more, building rapport if you can. If you really click with the board or you click with the chairman, you can go a long way. And we're all aligned here. They're supposed to be working for shareholders too. And we are working for shareholders, we're working for our funds. So interests should always be aligned. And we want to remind them of that. This is should not be acrimonious. If it's acrimony, then they're fighting something, and then say, well, either they're the wrong people or we're going down the wrong track here.
This is obviously integral part of your process. And I know I asked you this question in the past as well. But have you, all said and done about it, have you made any attempts, or do you have any gut feel as to the alpha that you think is being generated through, let's call it, a more activist approach? Can you or have you in the past tried to quantify it in any way?
Hard to tell, because it'll be bigger positions and I don't know. It definitely has increased. Definitely has added alpha, because some of our bigger holdings turned out to be right. So yeah, definitely. I mean, Old Mutual in 2011 was 12% of the funds, and we were writing it. We were engaging a lot with them. Two of our guys flew to Stockholm at the time to talk to Sevian, who were also engaging with them. And then lo and behold, they sold their Scandinavian business, and the stock went up 30% in the month. So we haven't really quantified it.
But it's material.
Generally, yeah.
Cool.
And also, if we've taken a big position, it's not working. Sometimes we know we've got more comfort getting out, as opposed to saying, well, maybe we should stay in. So it helps us to avoid losses too, in a sense. It's not just making gains, but avoided losses which others probably wouldn't have avoided.
I understand that. Maybe a question for you, Afri, back to the airlines example. The plane orders and order books are impressive, but it's much bigger than the component that was on the right-hand side of those slides, being the defense and space. Would you agree that that's maybe where the optionality lies, in the sense that the planes are the things you know about, but the space is the stuff that can just explode on a political turn or on a who knows? So maybe there's a lot of optionality sitting there. Would you agree with that?
Yeah, for sure. I mean, we've seen the agreements that Europe has done on the defense spending and percentage of GDP. They know that that has to rise. We don't know who the winners are going to be of those contracts, but Airbus definitely would be in the mix. Boeing, just because of the way that Trump has been, we don't know if they will be as big a beneficiary. But yeah, but that is optionality over and above the core story here.
Thank you. Patrice, there is a question in the box that comes from a fellow asset consultant in the industry, and it says, how do participants view the potential for hedge fund fees to align more closely with those of traditional CISs as they become integrated into the same regulatory framework? Now, up front, when I did the introduction, I said we don't want to have long debates about fees, for the fear that it becomes too long, and maybe it's a good plan to have a separate session almost dealing with that at some point. But, given that we have you on the line and you are a very kind of senior and experienced guy in the hedge fund industry in our country, maybe you do want to give, in the few minutes we have left, some views on that. I think I've tried in my introduction to give some pointers as to think one should think about structurally. The one thing that I neglected to mention at the time is that obviously in the current regulatory environment where hedge funds have now come into the CIS framework, all returns are always net of fees. So what you see is what you get, all considered. But yeah, maybe Patrice, I know you have strong views on many things, so maybe you want to give a few pointers on this.
Yeah, well, I can't profess to speak on behalf of everybody in the hedge fund space, so I'm not going to. I'll just give you a couple of my views, is that I want my money to be in the hedge fund. Okay, because I don't want my money. In fact, my money's in hedge funds, not in long-only stuff. Only for a number of reasons. Firstly, we can deploy different strategies to a conventional fund manager, to a conventional fund. Okay. Secondly, a conventional fund only has to outperform an index, even if it's losing money. Okay, so if the index loses 20 and you've lost 15, you may look like a hero. But I don't want that for my personal money. I want to mitigate the downside. And I believe a hedge fund does that a hell of a lot better. I'm not even sure what the cost of those fees would have been to protect that 15%, but I'll gladly pay it, whatever it is at the end of the day. And then the other point is hedge funds don't make money unless there's positive performance, and sometimes positive performance above a benchmark. A long-only manager will still make fees if he's outperformed. Sometimes no matter how bad the return is, if he's outperformed a 20% down performance by doing 15, he might even get a fee. We don't get fees unless you show positive or plus return. We don't get performance fees. So you take those things into account. I'm not sure what the actual cost of the fee is at the end of the day in the overall return, but I much prefer having my money deployed into stuff that's a bit more risk mitigating, that allows different strategies, that's more broad, like having options, things like that, and concentrated portfolios, not 50 stocks of 1% or 2% each, have some conviction. So that's why I think hedge funds do deserve to get paid.
Thanks a lot. Thanks for that. I'm not sure whether Adrian and Nobatibana are still on the line. Maybe they can switch on their cameras. If they are, then you can direct a question or two to each of them in the last few minutes. Adrian, similarly, you've been in the industry for a long time. In 1 or 2 minutes, what do you think the most critical questions are that investors can ask of their hedge fund manager in the strategy space that you
what do I think is the most important? I'd say
due diligence questions. What are the tips to listeners? What are the questions to ask a manager?
I think obviously it depends on the sophistication of being able to adjudicate your manager. But I think the most important issue is to get your manager to articulate his process, exactly what his process is. And like Patrice and Offrey have done rather well, is actually show the way they do things. And then you can reconcile that to what their performance is, and actually then start matching it and saying, well, are they doing what they say they're doing, or are they doing something different? Is their style drifting? They started off saying this 4 years ago, now they're doing this. So they're doing something different. So on any level, I think it's really to understand what that process is. If you relate to it and you like it and the results are good, then I think you've got a good manager. But I think there's often a huge amount of incongruence between what the people say the process is and the results are.
Thanks for that.
Yeah.
Thank you. And same question really in the last minute to Novatibana as well. I've previously said, I think with no offense meant to the long-short equity managers, but fixed income hedge funds are maybe a bit more difficult for retail investors to understand. So the question is, how does retail investors get a good handle on fixed income hedge funds? Where do they start upskilling themselves? What questions should they ask the managers?
I mean, as part of or asking the question about the overall process, I think specifically for a fixed income hedge fund, you kind of want to understand where the manager makes their money across the curve, because it kind of gives you an idea of their focus areas. As I mentioned, there's focus areas around monetary policy, there's focus area around the macro cycle, and also from fiscal policy. And also it gives you a sense of how scalable that process, that overall process is through the cycle, because you can make money at different cycles, but sometimes depending on where your focus area is, it can be difficult to outperform. And I think also from a risk management perspective, when it comes to fixed income hedge funds, I'm mindful that the regulation speaks about value at risk. For a fixed income manager, you want to understand more the, mathematical term DV01 Rand per point. Essentially, how much Rand is the manager going to make or lose for every basis point move in interest rates? That's a better sense of the risk management measure for a fixed income hedge fund than just simply the value at risk.
Thanks for that. I think that's a very valid point, which is a bit technical, but I think that's the the crux or important point about fixed income, as you say, to understand the appropriate risk metrics to apply to those funds and to understand. We are at time. Thank you very much for your time today and the insights you've offered. As always, we really appreciate that. I'll discuss it with FundRock and BCI, but I certainly think we can do sessions in the future which are maybe a bit more operationally oriented, not truly operational, but to have lively debates about all the aspects around fees and the fairness and the structures and where it's, what's sensible and what's not and where it's going. And then also the taxability. I know, Novatibana, you got a curveball question about hedge fund tax in a previous session recently, which is maybe outside of your ambit of expertise, but I think, that's also relevant to investors to understand those things in a space that is maybe slightly different from what they were used to in the past when they only invested in long-only CISs. So thank you very much for your time today. It was great having all of you, and very different and diverse things we've discussed, and we like that, and we think that adds flavor and value to the discussions and to our clients. Thank you for being open to our engagements always, and for sharing information and for sharing views. We do appreciate that, and similarly on behalf of FundRock and BCI. To the audience, thanks for joining us. Any questions that we couldn't answer, we'll get answers to you. And then lastly, in the next number of weeks, the next 3 Wednesdays, we move on to global fund webinars starting next Wednesday. And it's different global funds and different managers every Wednesday for the next 3 weeks. And we also look forward to that. Thank you very much. Thanks to our speakers, thanks to FundRock BCI, and thanks to the audience. Enjoy the rest of your day.